Welcome to the deep dive. Okay, today we're jumping right into, well, a tax topic that can definitely be a bit of a maze. Figuring out when you can actually deduct business losses. Those losses show up, but can you use them?
It's a really common question, and yeah, it's not always straightforward. We've got some great source material here that talks about it like a series of hurdles you have to clear, which I think is a really helpful way to picture it.
Totally agree. Because if you're an individual, maybe you've invested in a partnership or an S Corp, or maybe even a sole proprietorship that's losing money, well, you can't just take that loss number and subtract it from your salary. Not automatically, anyway.
Exactly. The tax rules have these layers, limitations, designed to control when and how those losses get deducted.
And that's our mission for this deep dive. We're going to break down these layers. We'll look at the four main hurdles, understand the order, which is super important. You have to do it in the right sequence, and see what actually happens to the losses that get, stopped along the way.
Right. Can you use them later? Are they gone forever? We want to hit the key concepts quickly, based on our sources, so you get the crucial info without getting totally bogged down.
Perfect. Let's lay the groundwork. So the sources identify these four main limitations for individual taxpayers looking at business losses.
Yeah, 4 hurdles. And the key, like you said, is sequential. A loss has to get past hurdle number 1 before it even gets looked at by hurdle number 2, and so on down the line.
Okay, so what are the four? Lay them out for us.
Okay. Hurdle 1, the tax basis limitation. If your loss clears that.
Okay.
It runs into hurdle 2. The at-risk limitation, get past that one.
Yep.
Then you face hurdle 3, which is often a big one. The passive activity loss, or PL limitation.
The PL rules. Heard of those?
And finally, if anything's left, hurdle 4, the excess business loss limitation.
Got it. Tax basis, at risk,
Yeah.
PL, excess business loss, sequential. And I think you mentioned the first two work a bit differently from the last two in terms of where they apply.
Precisely. The tax basis and at-risk limits, generally speaking, they apply at the entity level for your flow-through businesses, think partnerships, S-Corp. They basically determine how much loss is even allowed to pass through from the business to you, the owner.
Okay, so the business itself might have a loss, but basis and at risk act like gatekeepers on the business side,
Yeah.
saying, whoa, hold on, maybe not all of that loss gets to go onto the owner's personal K-1 form this year.
That's a perfect way to put it. They're the first check. Then, whatever amount of loss does make it past those first 2 hurdles and lands on your individual return.
Like on my Schedule K-1.
Yeah, exactly. That amount then faces the next 2 hurdles, PAL and excess business loss, and these apply right there on your individual income tax return. They restrict how much of that loss that already passed through you can actually use to offset your other income, like your wages or investment income, in the current year.
So wait, a loss could make it through basis and at risk, show up on my K-1, land on my 1040, but then PAL or EBL could say, nope, you still can't deduct it all this year.
Absolutely. It's a multi-step process, and you absolutely must do it in that order. Tax basis first, then at risk, then PL, then excess business loss. Any loss amount stopped at a hurdle is usually suspended, put on hold.
Okay.
Only the amount that clears moves on to the next hurdle.
Man, okay. This is why anyone involved in a partnership or S-Corp, or even some rentals or side businesses, really needs to get this. It's the difference between getting that tax break now,
Or later.
or, as we'll see, maybe never.
It really dictates the true tax value of that loss to you personally.
All right, let's tackle hurdle 1, the tax basis limitation. What exactly is tax basis in, say, my partnership interest?
Okay, think of tax basis as kind of like your financial stake in the business from the tax perspective. It's not a static number, though. It moves around. It generally starts with what you put in cash, property.
My initial investment.
Right. Then, crucially, your basis goes up when the entity makes money, your share of its income, both taxable and tax-exempt. It also goes up if you contribute more capital later. And for partnerships specifically, it can also go up by your share of the partnership's debt.
Okay, up for income, contributions, maybe debt in a partnership. What makes it go down?
It goes down by your share of the entity's losses and deductions, and also by any distributions the entity makes to you, cash or property you take out.
So it's like a running tally. Starts with my investment, goes up with profits and more contributions, goes down with losses and distributions. Makes sense. And the rule.
The core rule for this hurdle is pretty straightforward. The amount of loss from the entity that can pass through to your personal tax return is limited to your tax basis in that entity at that time.
So if my basis is, say, $10,000, but my share of the loss for the year is $15,000, only $10,000 of that loss actually gets past this first gate.
Correct. Only $10,000 flows through.
What happens to the other $5,000, the part that exceeded my basis?
That $5,000 is suspended due to the tax basis limitation. It's put on hold. Can't use it this year.
Suspended. Okay. Does that mean it's lost forever?
No, not necessarily. Not immediately, anyway. The good news here is that these suspended tax basis losses are carried forward. Indefinite.
Indefinitely. Okay, so they hang around.
Yeah.
How do I eventually get to use them?
You can potentially use them in a future year if your tax basis gets restored or increased.
How does that happen?
Well, maybe you contribute more cash or property to the business, or the business starts making profits, and your share of that income increases your basis. Once your basis goes up, it creates room to absorb those previously suspended losses, allowing them to flow through in that future year.
So they're kind of waiting in the wings for my basis to recover. But what if it doesn't? What if I sell my interest in the partnership before my basis gets high enough to use those suspended losses?
Oh, okay. This is the really critical point about suspended basis losses. And it can be, well, painful if you sell or otherwise dispose of your entire interest in a taxable transaction before you've generated enough basis to absorb those suspended losses. Those specific suspended tax basis losses are permanently lost.
Permanently, like just gone, poof.
Poof. Vanished. You cannot use them to offset the gain you might have from selling the interest. You can't use them against your salary, your dividends, nothing. They just disappear.
Wow, that's harsh. So keeping track of my basis isn't just good bookkeeping. It's essential to actually getting the benefit of the losses eventually.
Absolutely essential. If you let your basis drop to 0 or below through losses and distributions, any further losses are suspended, and if you sell at that point, those suspended basis losses are gone. And this rule applies to all activities, active or passive. It's always the first hurdle.
Okay, hurdle 1, tax basis. Tough consequences if you exit with suspended basis losses. Let's say a loss does clear the basis hurdle. It then immediately faces hurdle 2. The at-risk limitation. What's at risk? How's different from basis?
At risk is about your economic risk, how much you personally stand to lose if the business goes completely bust. It's trying to measure your real skin in the game.
Is it calculated the same way as basis?
It's often very similar, but there's a huge potential difference, and it usually comes down to debt. Remember how partnership basis can include your share of the partnership's debt?
Yeah.
Well, your at-risk amount specifically excludes certain types of debt, primarily. Debt for which you have no personal liability.
No personal liability. You mean like non-recourse debt?
Exactly, non-recourse debt. That's debt where if the business defaults, the lender can only seize the specific property pledged as collateral for that loan. They can't come after your other personal assets, your house, your savings account, whatever.
Okay, so if the business bought, say, a big machine with a loan, and the only thing securing that loan is the machine itself. If the business fails, the bank takes the machine, but they can't sue me personally for any shortfall if the machine isn't worth the full loan amount.
That's the idea. You're not personally at risk for repaying that debt beyond the value of the collateral. So because you don't have that personal exposure, that non-recourse debt generally does not increase your at-risk amount.
Even if it increased my tax basis, especially in a partnership.
Correct. That's a key difference. Non-recourse debt can create tax basis, but often doesn't create an at-risk amount.
So what does count towards my at-risk amount, typically?
Typically, it's the cash you contribute, the tax basis of property you contribute, and your share of any recourse debt that's debt where you are personally liable if the business can't pay.
Okay, so cash in, property in, recourse debt in. Non-recourse debt is generally out. Any exceptions where non-recourse debt does count for at-risk?
Yes, there's a significant one. Qualified non-recourse financing. This usually applies to real estate activities. It's typically financing secured by real property, borrowed from a commercial lender who's unrelated to, you think, a standard mortgage on an apartment building from a bank. Even though it's technically non-recourse, because it's qualified, it is included in your at-risk amount for that real estate activity.
Ah, okay. So a regular mortgage on a rental property, even if non-recourse, usually does count for at-risk, but other types of non-recourse debt often don't. That's a really important detail.
It is, especially in real estate deals.
So once we figure out the at-risk amount, how does the limitation work? Is it like the basis rule?
Yep, the mechanic is the same. The loss amount that made it past the basis hurdle is now tested against your at-risk amount. You can only deduct the loss up to the amount you have at risk.
And if the loss is more than my at-risk amount, say $30K loss cleared basis, but I only have $25K at risk,
then the excess $5,000 is, you guessed it, suspended. This time, it's suspended due to the at-risk limitation.
Okay, suspended again. Carried forward indefinitely, like the basis ones.
Yes, carried forward indefinitely. And you can potentially use them in future years if your at-risk amount increases. Maybe you contribute more cash, the activity generates income that you don't withdraw, or maybe you convert some non-recourse debt to recourse, increasing your personal exposure.
Okay, so suspended, carried forward.
Right.
But what about the disposition rule? We saw suspended basis losses are lost forever if you sell. What happens to suspended at-risk losses when you sell the activity?
And here's the second major difference in how suspended losses are treated. It's much better than the basis rule. If you dispose of your interest in the activity in a fully taxable transaction, any losses that were previously suspended specifically because of the at-risk rules, well, you can use them.
Oh, how? Can I use them against my salary?
Not quite against any income. You can use those suspended at-risk losses to offset any gain you recognize from selling that specific activity.
Ah, okay. So not lost forever like the basis ones. But their use is restricted only against the profit from selling that investment. Still, better than nothing.
Definitely better than nothing. It reduces your taxable gain on the sale, which is valuable. But yeah, if the gain isn't big enough to absorb all the suspended at-risk loss, the rest doesn't just flow over to offset your wages or dividends. And just like basis, the at-risk rules apply regardless of whether you materially participate or not.
Okay, so basis and at-risk are the first two hurdles, mainly checking my investment level and my actual economic exposure, often at the entity level. If a loss clears both, it makes it to my personal return. But the journey's not over yet. Hurdle 3, the passive activity loss, PL limitation. This feels like the big one for a lot of investors.
It really is, yeah.
Yeah.
The PL rules were put in place quite a while ago now, specifically to stop people from using, say, losses from tax shelter investments they weren't really involved in to offset their regular job income or investment portfolio income. The core idea is segregation.
Segregation.
Yeah. You have to sort all your income and losses into 3 different categories, or baskets, as they're often called.
Okay, the 3 PL baskets, what are they?
Basket 1 is active income or loss. This is generally income from work you actively do. Your salary, wages, maybe guaranteed payments from a partnership for services you provide. It also includes income or loss from a trade or business activity where you materially participate.
Materially participate. We'll need to define that. Okay, so active is basically earned income or income from a business I'm hands-on with.
Pretty much. Basket 2 is passive income or loss. This is the flip side. It comes from trade or business activities where you do not materially participate. You're more like a passive investor.
Like a silent partner. Or maybe investing in a business managed by others.
Exactly. Also, rental real estate activities are generally, by default, put into this passive basket, regardless of how much time you spend, unless you qualify for one of the specific exceptions we'll talk about. And if you're a limited partner in a limited partnership, your income or loss from that is typically automatically passive too.
Okay, so passive is where I'm not heavily involved. Or it's rental real estate generally. You keep saying material participation. What does that actually mean? How much involvement is material?
Right. The tax code and regulations have several tests to determine material participation. It basically means your involvement is regular, continuous, and substantial. But the most common test, the one people usually focus on, is participating in the activity for more than 500 hours during the tax year.
500 hours.
Yeah.
So like 10 hours a week, roughly.
Yeah, it's a significant time commitment. There are other tests, too, like if you do substantially all the participation, or if you have significant participation in several activities that adds up, or a facts and circumstances test. But honestly, if you're spending over 500 hours, you generally meet the standard for that activity. If you don't meet one of these tests,
Then it's probably passive.
for a trade or business activity, yes, it generally defaults to passive if you don't materially participate.
Okay. Active basket, passive basket. What's the third one?
Basket 3 is portfolio income. This is your classic investment type income. Think interest, dividends, annuities, royalties not derived from a trade or business, and capital gains and losses from selling assets like stocks and bonds.
Got it. Wage active, business inactive. Rentals businesses I don't run in passive. Interest, dividends, capital gains, and portfolio. Okay, we've sorted everything. Now, what's the actual PAL limitation rule?
This is the heart of it. Passive activity losses, the losses falling into that passive basket, can only be used to offset passive activity income that's also in the passive basket.
Only passive losses against passive income.
That's the rule. You absolutely cannot use a loss from the passive basket to reduce your income in the active basket, like your salary, or your income in the portfolio basket, like dividends or stock gains, in the current year.
Whoa. Okay. So if I have the $10,000 loss from a passive business activity,
Hmm.
it already cleared basis and at risk, but I only have $2,000 of passive income from, say, a rental property, I can only use $2,000 of that loss this year.
That's exactly right. The $2,000 passive loss offsets your $2,000 of passive income. They net out within the passive basket.
Can the other $8,000 of the passive loss, the part I couldn't use?
That $8,000 net passive loss for the year is, you guessed it, suspended.
Yeah.
This time, suspended by the PL rules.
Another suspended loss category. Okay.
Yeah.
Carry forward indefinitely again.
Yes, carried forward indefinitely.
How do I unlock these suspended PLs? Do I need more basis or at risk?
Nope, these are unlocked differently. Suspended PLs carried forward can be used to offset future passive activity income. So if next year you still have that business loss activity, but maybe your rental property generates $12,000 of passive income, you could use the $8,000 suspended PL from the prior year plus any current year passive loss against that $12,000 passive income.
Okay, so they wait for future income within that same passive basket.
Mm-hmm.
But what if I sell the activity that generated the PLs? Is there a special rule like with the other suspended losses? What happens to all those accumulated suspended PLs when I finally sell the whole investment?
Yes. And this is the third critical distinction, and often the most favorable one. When you dispose of your entire interest in a passive activity in a fully taxable transaction to someone unrelated, any suspended PLs that you've accumulated from that specific activity over the years are generally released.
Released, meaning I can finally deduct them.
Yes, and here's the kicker. They become deductible against any category of income in that year of disposition.
Any category. So against my active income, like my salary.
Yes.
Against my portfolio income, like capital gains from selling stocks.
Yes.
Against other passive income, too, obviously.
Yes. Active, passive portfolio doesn't matter anymore in the year you fully dispose of the passive activity that generated those losses. The accumulated PLs from that activity are essentially freed up to offset whatever income you have.
Okay, that is huge. That's way different from suspended basis losses being lost forever and suspended at-risk losses only offsetting the gain from that specific sale. PLs get fully unleashed against everything when you sell.
Generally, yes, for a complete taxable disposition. It's a very powerful release valve in the PL system. It means you might not get the benefit year to year if you lack passive income, but you often get to catch up and claim those losses when you finally exit the investment. Understanding this disposition rule is vital for tax planning.
Absolutely. That difference in treatment upon sale is just critical to grasp. Okay, you mentioned rental real estate is automatically passive unless an exception applies. Let's talk about those exceptions. How can rental losses sometimes escape the PL trap?
The sources highlight two main exceptions for rental real estate losses. The first one is often called the mom and pop exception.
Mom and pop. Okay. What does it do?
It allows certain individuals, not corporations or trusts, to potentially deduct up to $25,000 of net passive losses from rental real estate activities against their non-passive income, like wages or portfolio income.
$25,000 against my salary. That sounds pretty good. What are the catches?
There are a few key ones. First, you have to actively participate in the rental activity.
Is that the same as materially participate, like the 500-hour test?
No, thankfully it's a lower standard. Active participation generally just means you're involved in management decisions, things like approving tenants, deciding on rental terms, approving capital expenditures or repairs. You don't necessarily have to be doing the day-to-day work or meet a high-hour threshold. Using a property manager doesn't automatically disqualify you as long as you retain decision-making authority.
Okay, so actively participate, make real decisions. What else?
Second, you generally need to own at least a 10% interest in the value of the rental activity throughout the year.
10% ownership, active participation. If I meet those, I can deduct up to $25K of rental losses against other income.
Potentially, yes. But there's one more big catch: an income phase-out. That $25,000 maximum allowance isn't available to everyone. It starts getting reduced once your modified adjusted gross income, or MEGI, which is usually pretty close to your AGI, exceeds $100,000.
Okay, how does the phase-out work?
The $25,000 allowance is reduced by 50 cents for every dollar your MEGI goes over $100,000.
So let's say my MEGI is $120,000. That's $20,000 over the limit. Half of that is $10,000. So my $25,000 allowance is reduced by $10,000, meaning I could only deduct up to $15,000 under this exception.
Exactly right. And doing the math, once your MBI hits $150,000, the $25,000 allowance is completely phased out. $50,000 over 50%, it was $25,000 reduction. So this exception really helps moderate income taxpayers who actively manage their own rentals.
Got it. A nice break, but limited by income. What's the other big exception for rentals?
The second one is much more powerful, but also much harder to qualify for. It's for taxpayers who qualify as a real estate professional for tax purposes.
Real estate professional. Okay, what does that take? Is it just having a real estate license?
Oh, definitely not. It's a much stricter two-part test based on your time and activity. First, more than 50% of all the personal services you perform in all trades or businesses during the year must be performed in real property trades or businesses in which you materially participate.
More than half my entire working time has to be in real estate businesses I'm materially involved in. Wow. Okay, what's part two?
Part two is you must perform more than 750 hours of services during the year in those real property trades or businesses where you materially participate.
750 hours plus the more than half your time test. That's substantial. That's like 15 hours a week minimum, purely in real estate work where you're materially involved. And that has to be the majority of your work life.
It's a high bar, absolutely. It's generally meant for people whose primary business is real estate think developers, full-time property managers, brokers, construction contractors, etc., who spend significant time materially participating.
Okay, but if you do meet both those tests and qualify as a real estate professional, what happens to your rental activities?
If you qualify and you materially participate in your rental activities, which is a separate determination, sometimes requiring grouping elections, then those specific rental activities are treated as non-passive or active.
They're pulled out of the passive basket entirely.
Essentially, yes, which means the PLL limitation simply does not apply to losses from those rentals.
So those losses could then potentially offset your salary, portfolio income, whatever, subject only to the other rules.
Exactly. Subject to the basis rules, the at-risk rules, and that final hurdle, the excess business loss rule. But the PLL hurdle itself is removed for those specific rental activities if you meet the real estate professional test and materially participate in the rentals.
That's a huge benefit, but yeah, clearly not for the casual landlord. It requires a serious primary commitment to the real estate field.
It really does.
Okay. So losses have navigated basis, then at risk, then the tricky PL rules, maybe getting stuck, maybe offset by passive income, maybe escaping via an exception. If any deductible loss remains after all that, it faces the final gate. Hurdle 4, the excess business loss limitation. What's this one about?
This is the newest of the 4 hurdles, brought in by the Tax Cuts and Jobs Act back in 2017. It applies after you've done all the payout calculations and figured out how much of your business loss would otherwise be deductible against your other income. It basically acts as an overall annual cap on the total net business loss an individual can claim.
A cap on my total business losses for the year, regardless of whether they were active or passive originally.
Correct. You aggregate all your business income and losses from all your activities, partnerships, S-Corp, sole proprietorships, even farm losses after applying the basis, at-risk, and PL rules. You figure out your overall net business gain or loss for the year. If you have a net loss, you compare that loss to an inflation-adjusted threshold amount.
And what's the rule if my net business loss is above that threshold?
If your total business deductions exceed your total business gross income plus that threshold amount, the excess is disallowed as a deduction in the current year. That disallowed amount is your excess business loss.
Okay, what are those threshold amounts? The sources had figures for 2023.
Yeah, for 2023, the threshold was $578,000 for married couples filing jointly, and half that, $289,000, for all other taxpayers single, married filing separately, head of household. These amounts get adjusted for inflation each year.
So let's say I'm single, and after basis, at risk, and PL, I have a net business loss from all my activities combined of, say, $300,000. The single threshold is $289,000. Does this rule mean I can only deduct $289,000 of that loss this year?
Essentially, yes. Your total deductible business loss is limited to your total business income plus the $289,000 threshold. Since you had a net loss, meaning deductions already exceeded income, your deduction against non-business income is effectively capped at the threshold amount, $289,000.
And the amount above the threshold in my example, the $11,000 difference, $300K loss, $289K threshold, what happens to that? Is it suspended like the others?
It's treated a bit differently. That $11,000 excess business loss is not deducted this year. Instead, it's carried forward to the next tax year, but is treated as a net operating loss, or NOL.
Ah, an NOL. And do NOLs have their own limitations on how they can be used in future years?
Yes, they generally do. According to the source material, NOLs carried forward, including those created by the EBL rule, are typically limited in how much taxable income they can offset in a future year. The common limitation mentioned is that the NOL deduction is limited to 80% of the taxable income in that future year, calculated before the NOL deduction.
Okay, so even if I have a huge loss that clears the first 3 hurdles, this EBL rule can still push a chunk of it into future years as an NOL, and even then, the NOL might be limited in how much it can reduce my taxes later. This rule definitely seems aimed at taxpayers with very large overall business losses.
That's exactly its target. It's the final backstop, putting an annual ceiling on how much net business loss can be claimed, regardless of basis, at-risk, or passive income status.
All right. We've got the 4 hurdles laid out: tax basis, at-risk, PALO, excess business loss. We know the strict order. We know they have different consequences for suspended losses. Let's really cement this by walking through the examples from the source material step by step.
Great idea. Examples make these rules much clearer. The first one just classifies income types. It uses Michael, who's single. He's got a $40,000 loss share from M. Green & Sons partnership. He's a limited partner, doesn't materially participate. He also invested in another partnership, Morris & Stubbs, also doesn't materially participate, and that one gave him $6,000 of income. Plus, he has $75,000 in wages, $12,000 in dividends, and a $3,000 long-term capital gain.
Okay, let's put Michael's stuff into the PL baskets.
Wages. $75,000 wages, that's income from services. Definitely active.
The $6,000 income from Morris & Stubbs, where he doesn't materially participate.
Doesn't materially participate means that's passive income.
Dividends, $12K, and the capital gain, $3K.
Classic investment income. That's portfolio.
And finally, the big one, the $40,000 loss from M. Green & Sons. He's a limited partner, doesn't materially participate.
That makes the $40,000 loss a passive loss.
Okay, active-passive portfolio sorted. Now let's take that $40,000 passive loss from M. Green & Sons and run it through the 4 hurdles. The source gives us his numbers. Tax basis is $30,000, and at-risk amount is $25,000. Ready?
Let's do it. Step 1, tax basis limitation.
His loss is $40,000. His basis is $30,000.
The loss allowed through is limited to basis, so only $30,000 of $40,000 loss clears hurdle 1.
And the $10,000 difference. $40K, $30K.
That $10,000 is suspended due to lack of tax basis.
Oh.
Carried forward. Remember the rule. If he sells before basis is restored, that $10 is lost forever.
Ouch. Okay, $30,000 loss proceeds to hurdle 2, at-risk limitation.
The loss amount we're now looking at is $30,000. Michael's at-risk amount is $25,000. The loss deduction is now limited to the at-risk amount.
So 30K loss hits the $25K at-risk ceiling. Only $25,000 gets through.
Correct. Only $25,000 clears the at-risk hurdle.
Meaning another $5,000, 30K, 25K gets stopped here.
Yes. That $5,000 loss is suspended due to the at-risk limitation. Carried forward. Remember this rule. If he sells, this $5K can be used to offset gain on the sale of this specific interest. Not lost forever, but limited use on exit.
Got it. Different fate than the basis suspension. Okay, so $25,000 of the original $40K loss has cleared the first 2 hurdles. It's now on Michael's personal return. Time for hurdle 3, PL limitation.
Right. The loss amount now in play is $25,000. We already determined it's a passive loss because Michael doesn't materially participate. Now we look at his passive income.
He had $6,000 of passive income from that other partnership, Morris & Stubbs.
Exactly. And the PL rule says passive losses can only offset passive income. He has $6,000 of passive income available.
So he can only use $6,000 of that $25,000 passive loss right now to offset that $6,000 passive income.
Precisely. He gets a current deduction for $6,000 of the loss.
What about the rest of that $25,000 loss? The other $19,000, $25K, $6K?
That $19,000 is suspended due to the PL limitation. Carried forward indefinitely. Remember the rule here. Use against future passive income or fully released against any income upon complete taxable disposition of the M. Green & Sons activity.
The most flexible outcome upon sale. Okay, so after PL, only $6,000 of the original $40,000 loss is currently deductible. Last step. Hurdle 4, excess business loss limitation.
The amount of business loss potentially deductible this year after working through the first 3 limits is $6,000. Michael is single. The EBL threshold for single filers in 2023 was $289,000.
$6,000 is obviously way, way below $289,000.
Correct. So the EBL limitation doesn't apply here. It doesn't restrict his $6,000 deduction.
Okay, let's summarize Michael's situation for this $40,000 loss in the current year.
He gets to deduct $6,000 currently, offsetting his passive income. He has $10,000 suspended due to tax basis rules. He has $5,000 suspended due to at-risk rules, and he has $19,000 suspended due to PL rules.
Let's check the math. 6K deductible plus $10K basis suspended plus $5K at-risk suspended plus $19K PAL suspended. Yep, that adds up to the original $40,000 loss. Every dollar accounted for, but flowing into different buckets deductible now or suspended under 3 different rule sets with different future consequences, that really clarifies the sequence.
It's the only way to get the right answer. You have to apply them in order and track the suspended amount separately.
Let's try another one from the source, example 4. This one involves Rachel, single, who forms an LLC, taxed as a partnership, for rental real estate. She's not an active participant. She puts in $100K cash. The LLC borrows $20K recourse, she's liable, and $30K non-recourse, not qualified, she's not liable. Year 1 loss is $50K, no other passive income.
Okay, first things first. Calculate her basis and at risk. Tax basis in a partnership includes cash, property, and her share of all partnership debt recourse and non-recourse.
So $100K cash plus $20K recourse plus $30K non-recourse equals $150,000 tax basis.
Correct. $150 K basis. Now, at risk amount, this includes cash, property, and only debt she's personally liable for, recourse, or qualified non-recourse financing. This $30 K non-recourse isn't qualified.
So it's just the $100K cash plus the $20K recourse debt? That's $120,000 at risk. The $30K non-recourse is excluded from at risk here.
Exactly. $120K at risk. Notice the difference. $150K basis, but only $120K at risk because of the non-recourse debt.
Okay, got the numbers. Her loss is $50K. Let's run the hurdles. Hurdle 1, tax basis.
Loss is $50K. Tax basis is $150K. Since $50K is less than $150K, the loss fully clears the basis hurdle, $50K proceeds.
Good. Hurdle 2, at risk.
Loss amount is $50. At-risk amount is $120K. Since $50K is less than $120K, the loss fully clears the at-risk hurdle too, $50K proceeds.
Excellent. Clear the first 2. Hurdle 3, PL.
The activity is rental real estate. Rachel is not an active participant, so no mom-and-pop exception, and we assume she's not a real estate professional. Therefore, by default, this rental activity is passive. The $50,000 loss is a passive loss. Does Rachel have any passive income?
The example says no. 0 other passive income.
Okay. PAL rule. Passive losses only offset passive income. She has none.
The entire $50,000 passive loss gets stopped right here. Can't be deducted.
Correct. Because she has no passive income to absorb it, the entire $50,000 loss is suspended by the PAL rules.
Wow. So currently deductible loss for Rachel this year is 0.
0 deductible now. The full $50,000 is suspended as a PL, carried forward indefinitely, waiting for future passive income or the eventual sale of the LLC interest.
In hurdle 4, excess business loss.
Since $0 was deductible after applying the PL rules, the EBL limitation isn't triggered for a current year deduction. There's no excess loss because there's no potentially deductible loss amount left to limit.
So Rachel's $50K loss sailed through basis and at risk because her investment and recourse debt were sufficient but hit a brick wall at PL because it was rental, passive by default for her, and she had no offsetting passive income. Shows how powerful PL can be.
Absolutely. It's often the most significant hurdle for passive investors and many rental owners.
Okay, let's revisit Michael and his suspended losses. Example 3 looks at what happens next year when he sells his M. Green & Sons interest for a $20,000 gain. Remind us of his suspended losses from the prior year.
He had $10,000 suspended by tax basis, $5,000 suspended by at-risk, and $19,000 suspended by PL. Total $34K suspended.
Okay, now he sells. How are those treated? Let's start with a $10,000 suspended by basis.
This is the harsh one. On disposition, that $10,000 suspended tax basis loss is permanently lost. Gone. Cannot offset the $20 gain, cannot offset anything.
Oof, still brutal. Okay, what about the $5,000 suspended by the at-risk rules?
This one gets partial relief. It can be deducted, but only against the gain from selling that specific M. Green & Sons interest.
So his $20,000 gain on sale is reduced by this $5,000 suspended at-risk loss. His taxable gain becomes $15,000.
Exactly. It shelters part of the sale gain, a definite benefit.
All right, and the big one, the $19,000 suspended by the PI rules.
This is where the major release happens. Upon the complete taxable disposition of the passive activity, those accumulated suspended PLs, $19K here, become fully deductible against any type of income Michael has in the year of sale.
Any income. So against his wages, dividends, maybe that $15,000 remaining capital gain from the sale itself.
Yes, yes, and yes. It can offset any income he has on his return that year up to the $19,000 amount.
So disposition treats suspended losses wildly differently based on why they were suspended. Lost forever basis offsets specific gain at risk or offsets anything, PAL. That's the key takeaway.
Absolutely fundamental to understand that difference.
Let's see the last example, example 5. This brings in the excess business loss rule. usually triggered by big events. It's Michael selling M. Green and Sons again, but this time, let's say his cumulative suspended PL from that activity over the years is a whopping $350,000. In the year he sells, he also has $20K passive income, Morris and Stubbs, $80K wages, and $400K in gambling winnings, which is ordinary income.
Okay, big numbers. Michael sells M. Green and Sons. It's a passive activity disposition. What happens to the $350,000 suspended PL?
Based on what we just said, it gets released. It's now potentially deductible against any income.
Correct. Released. But even though it's freed from the PL constraints, it originated as a business loss. So it now gets factored into the overall business loss calculation for the excess business loss limitation, that final hurdle.
Okay. So first we need to figure out his total net business income or loss for the year, now including that released PL.
Right. He has $20,000 of business income from Morris and Stubbs, and he has the $350,000 business loss from the released M. Green and Sons PL. So his net business position for the year is $20K income, $350K loss, x a net business loss of $330,000.
$330,000 net business loss. It cleared PL due to disposition, but now it faces the EBL hurdle. Michael is single. Threshold is $289,000.
The EBL rule limits his deductible business loss to his business income, $20K, plus the threshold, $289K. So the max business loss he can deduct this year is $20,000 plus $289,000, $309,000.
Okay, his net business loss was $330K, but he can only deduct $309K of it this year because of the EBL cap.
That's right. He uses $20,000 of the release PL against the $20,000 passive income. That leaves $330,000 of the loss. He can then deduct another $289,000, the threshold amount, against his other income like wages and gambling winnings. Total current deduction, $20K plus $289K was $309,000.
So what happens to the rest of the loss?
Yeah.
The total net loss was $330K. He deducted $309K. What about the $21,000 difference? Wait, let me recheck the source calculation. It's total deductions $350K minus total income $20K plus threshold $250K, so $309K.
Right. The calculation is based on the excess of aggregate deductions over aggregate income plus the threshold. So his aggregate business deductions were $350K, the release PL. His aggregate business income was $20K. The EBL is $350K, $20K plus $289K plus $280K. $309K equals $41,000.
Okay, $41,000 is the excess business loss. What happens to that $41,000?
But $41,000 is disallowed this year and is carried forward to the next year as a net operating loss, NOL.
And that NOL will be subject to its own limits, like maybe the 80% of future taxable income rule.
Exactly. So even a huge PL release upon disposition can still get partially deferred by this final EBL hurdle.
Man, that really shows how all four layers interact right up to the very end. Okay, we've been through the weeds, through the hurdles, through the examples. Let's pull back. What are the absolute must-know takeaways from this deep dive? Why is understanding this sequence so vital?
Well, fundamentally, it determines the timing and sometimes the very possibility of you getting a tax benefit from a business loss. You just can't assume a loss on paper translates directly to tax savings on your return this year.
And for me, the thing that just keeps jumping out is that stark difference in how suspended losses are treated when you sell. Basis losses, poof, gone. At-risk losses, only offset gain on that specific sale. PLLs, boom, unleashed against everything. You have to know which rule suspended your loss.
That is absolutely critical. It dictates the value of those suspended losses upon exit. It also underscores why tracking your basis and your at-risk amount isn't optional. It's crucial planning.
Right. And understanding material participation. Are you hitting 500 hours? Are you involved enough? Because that determines whether you're in the active or passive basket, which is a night and day difference for deducting current losses if you don't have passive income.
Precisely. And for rental owners, knowing those mom-and-pop active participation standards and income limits, or the very high bar for the real estate professional status, is key to potentially using those losses sooner.
Plus, having passive income becomes really valuable if you have passive losses you want to use. It's the key that unlocks those PLs before a sale.
It creates the capacity to absorb them year by year.
And finally, that excess business loss rule, while it affects fewer people, is a crucial backstop for those with very large aggregate losses, pushing some of that benefit into future years as NOLs.
It's the government's way of putting an overall limit on how much business loss can shelter other income in any single year. The whole system is this complex balancing act.
It really is. So thinking about all this complexity, the sequence, the different suspension buckets, the disposition rules, participation tests, here's a final thought. How might really understanding these rules change the way you look at a potential new business investment, especially a partnership or S-Corp, or maybe how you structure or manage the activities you already have.
That's the practical application, isn't it? Thinking about how these rules impact your decisions before you invest or as you operate.
Definitely something to chew on. Well, that wraps up our deep dive into the 4 hurdles of business loss limitations. Thanks so much for walking us through that maze.
My pleasure. It's complex, but hopefully breaking it down helps.
Until next time on The Deep Dive.